Hello, if you're looking for an outlook statement from First Real Estate Investment Trust, you have to look no further than the cover of the 2013 annual report. A strong pipeline kind of gives it away. Currently, First REIT owns 14 healthcare-related properties, hospitals in Indonesia, aged care homes in Singapore, and they have a property in South Korea too. $1 billion worth of assets, in fact, as you can see here on this bar chart, published in the annual report. Currently, they have 14 properties, but could add another 24 if they take up any offerings from their sponsor, Lippo Karawaci in Indonesia. It operates 16 hospitals under the Siloam brand, itself listed on the Jakarta Bourse, and that could provide the pipeline for First REIT. It has first right of refusal. Incidentally, if you read the chairman's statement, you'll also get a few hints that perhaps it's not just going to be properties from the sponsor that will be included. Let's take a look at the chairman's statement in greater detail, where you will also see a commentary about their $500 million medium-term note issue from April last year. That, as they say here, will mean that their refinancing needs are well taken care of all the way to 2016. Incidentally, they've also implemented a dividend reinvestment plan. So rather than collecting cash dividends, you simply take new, fully paid units. Thereby the cash stays with the company, and then they can use that cash for further acquisitions, even as you increase the number of units in the trust. So with the dividend reinvestment plan, the $500 million medium-term note issue, and so on, it seems to suggest that they are again in the starting blocks for more acquisitions. Currently, their debt level is around 32%. 35% is the ceiling, but as they also comment, they might consider the possibility of getting a credit rating so that they're able to attract more investors to the trust and support their future acquisitions, which is code for being able to go above that 35% limit if they have a credit rating. So obviously, if they're going to take on more debt, they're already inviting shareholders to keep the cash in the company through the dividend reinvestment plan. You can see that, again, they look like they're gearing up for more acquisitions. Incidentally, what's also interesting is the Indonesian focus. Here in this breakout, you see reference to those 24 properties that I mentioned, 16 hospitals in Indonesia. Indonesia, as they say, is well and truly the focus for future acquisitions. Incidentally, Lippo Karawaci is not just the sponsor and is not just the likely source of those future acquisitions. It is also the source for a large amount of the rent that First REIT collects. In other words, their operating income, more than 90%, as you can see here. So very much tied to that Indonesian group. But back to those colorful charts, and here is the page, incidentally, where you can see quite a number of them. It's page 4, and what you can see here also is the gross revenue at $83 million, up on a compound annual basis of around 20%. The revenue, incidentally, is paid to them in Singapore dollars. So even though they are predominantly Indonesian properties, their revenue is still in Sing dollars, which means that a lot of the currency risk that you might have owning a trust with properties in Indonesia is taken care of. Incidentally, the South Korean property pays in US dollars. But anyway, moving back to the net property income at $80 million, just slightly below the gross property income, so they seem to have their costs in check. Also of interest is this blue bar chart, and you can see that at 7.52 cents, the distribution per unit is now almost back at where it was before the rights issue in 2010. Back in 2008 and 2009, they paid 7.62 cents per unit. And the distributable amount, this is where those units get their money from. And this is the pool, I guess you could say. This is quite interesting because even though the net income is around 80 million, the distributable amount is actually only 52 million, so about 28 million short. Why is that, I might hear you ask? Well, for that we need to turn further back into the pages of the annual report, page 44 to be precise, where we then find the financial statements, and in particular what we see here is income tax is a fraction of what it was last year, about 1/9 of last year's tax. But we're also seeing a tripling in finance costs, Perhaps not surprising given the fact that they now have this medium-term note issue. But we also see a revaluation of properties in there. And that's particularly interesting because those properties have been revalued to the tune of $61 million, almost as much as their annual revenue. That $61 million revaluation is purely an accounting measure where they revalue the properties. In other words, there's no cash coming into the company. They're just assigning or ascribing a higher value. But at 61 million, that's twice the increase that they registered last year on this revaluation. What's also of note is this particular page when we flip the page over here, and we can see how in order to compute the distributable income, that $61 million is backed out again because it's just an accounting measure. But not just 61 million, including the tax, deferred tax, actually the amount backed out is $73 million. So all up, that's how we get to 52 million. That's the part of the reason why we are seeing the distributable income so much different from the income line that you might have seen earlier on in the annual report. Also of note is the cash flow statement, which is always interesting because in terms of cash generated, it was $63 million, which is up from $49 million last year. And one other small point to note, also of some interest, is this here from the balance sheet where they talk about the receivables. It seems that last year their receivables were less than 10 million. This time around, they're expecting to be paid almost $25 million in funds which have been invoiced but have not yet been paid. All of these details set to be discussed at the annual general meeting. Here are the details on the screen for you. Wednesday, the 30th of April at the Mandarin Orchard in 333 Orchard Road. Make sure that you read the annual report yourself before you go to the annual general meeting.